3 numbers. That's all it takes to decide whether you get approved for a mortgage, qualify for a luxury car lease, or get stuck paying insane interest rates through years. But here's what most Americans still don't realize in 2026. Banks are no longer judging your credit score the same way they did just a few years ago. A brand new scoring behavior is quietly changing how lenders look at your financial profile, and the people who understand it are boosting their FICO scores faster than ever, while everyone else keeps making outdated mistakes. Some people are seeing score jumps of 40 to 80 points without paying off massive debt or making 6 figures a year. And the wild part? Most banks and credit card companies aren't advertising this shift, because the less consumers understand credit, the more money lenders make from higher interest rates. So if you've been struggling to push your score higher, or you want access to lower APRs, better rewards cards, and cheaper loans, this might completely change how you think about credit in 2026.
For years, Americans believed the secret to a high credit score was simple: pay your bills on time, keep debt low, and wait patiently. While those things still matter, the newest FICO behavior models are paying closer attention to something called credit velocity. In plain English, lenders are now tracking how fast your balances change month to month, instead of only looking at your total debt. That means someone with moderate debt who manages their balances strategically can sometimes look less risky than someone who constantly maxes out cards and pays them off later. Banks are focusing more on patterns, consistency, and timing. This is where the 2026 credit trick starts changing the game. Here's the strategy people are using. Instead of waiting until the due date to pay their credit cards, smart borrowers are paying down balances before the statement closing date. That sounds small, but it creates a huge difference, because your statement balance is what gets reported to the credit bureaus. Imagine you have a $5,000 limit and spend $2,500 during the month. Even if you pay it off completely by the due date, the credit bureaus may still report you as using 50% of your limit if the statement closes before the payment clears. And high utilization is one of the fastest ways to drag down a FICO score. In 2026, with lenders analyzing monthly trends more aggressively, people are now strategically lowering reported utilization before statements generate. The result is that their profiles appear more stable and lower risk almost instantly.
But the real twist is how artificial intelligence is now influencing lending decisions behind the scenes. Many banks are quietly using AI-driven underwriting systems that look beyond traditional credit categories. These systems analyze spending habits, account stability, recurring subscriptions, and even overdraft behavior. Someone who constantly swings between high balances and zero balances may now appear financially stressed, even if their official score looks decent. Meanwhile, consumers who maintain predictable patterns are being rewarded with better approvals and lower interest rates. That's why many financial experts in 2026 are recommending smaller, more frequent payments throughout the month, instead of one giant payment at the end. Another overlooked trick involves authorized user accounts. This strategy has existed for years, but it's evolving again because newer scoring systems are becoming more selective about which accounts actually help you. In the past, people could simply get added to almost any credit card and instantly benefit from that account's history. Now, lenders are paying closer attention to whether the primary user has responsible spending patterns and low utilization. If the account holder is financially disciplined, becoming an authorized user can still dramatically strengthen your profile. But if the account carries unstable balances, it may no longer provide the same boost it once did.
And then there's the mistake millions of Americans are still making in 2026. They close old credit cards, thinking it improves their financial image. In reality, shutting down older accounts can reduce total available credit and shorten average credit age, both of which can hurt your score. Banks love when consumers unknowingly damage their own profiles because it keeps borrowers trapped in higher interest financial products. The consumers winning the credit game today are the ones treating their credit profile like an investment portfolio instead of just a bill to manage every month. At the end of the day, the new 2026 credit score trick isn't some illegal loophole or secret IRS hack hidden from the public. It's about understanding how modern lenders now measure financial behavior in real time. Timing matters more. Patterns matter more. Stability matters more. The people who adapt to these new scoring behaviors are unlocking lower mortgage rates, premium travel cards, higher credit limits, and thousands of dollars in savings over time. And while most Americans keep focusing only on paying bills by the due date, the smartest borrowers are already playing a completely different game.